Okay. All right, got it. So I'm going to start here. Like, thank you for all the questions. That's super helpful. That helps me to sort of narrow the scope in terms of the audience and what people are looking for. Um, I am going to share. So I created a program called the Fund Manager Accelerator. I'm actually going to share one or two of those slides that I've created in there to help me with my presentation today, with the hope of being able to cover some of this, some of the questions that have been asked. So I am not going to advocate for funds. I'm just going to provide you information that funds is an option that you can consider, either if you are focused on investor relations or if you are an operator. And if you are an operator, I think that funds come in very handy when you have experience. So that means you've maybe done a couple of, think about baseball, you've done a couple, single hits and got onto first base a couple times. And then you want to do maybe some doubles and maybe you want to just do some home runs. That's where like you can sort of show, okay, I've had like maybe 3 or 4 deals that have done very well. And maybe you've even, ideally, you have also gone full cycle. So maybe you've sold your some investments in your portfolio and have done fairly well. All of that can build your track record to then sort of say, hey, I'm now going to launch a fund doing what I have done very successfully over the last couple of deals. So from an operator perspective, so any operators in the space, that's the best path. That's how a fund makes sense. I wouldn't, if you're an operator and you are just working on your first deal, I would not recommend doing a fund, because I just think it's a little bit too early for that, because people are going to look for track record. Now, let's talk about like the different types of funds. And I'm just going to share my screen here. So share this guy, here we go. So the different types of funds. So there are, right. I can't get it to do what I want it to do. So I'm just going to go with the way it is. So let me just move this over here. All right. So all the different types of funds, you have blind funds. So blind funds are funds where essentially, going back to the operator example that I just mentioned a couple minutes ago, that's a situation where, actually move this over here so I can see you guys. Yeah. So you have blind funds. So blind funds, you typically outline what your investment strategy is. And based on outlining, say you're just going to be investing in multifamily, class B, certain types of vintage, you can get as specific or broad as you'd like, depending on how well you are at executing, finding deals in that particular metric. So that's the blind fund. The blind fund actually requires you to have track record for sure, because people are going to be looking at your track record to determine whether they want to invest in your fund. It's blind because your investments are not yet identified. So at the time at which the fund has launched, people are putting money into your fund because they believe in you and your track record and what you've done before. The next type of fund that's out there is fund of funds. So fund of funds is very similar to like what Greg created earlier, what he mentioned, which is also called it can also be a special purpose vehicle. However, the difference between a regular fund of fund and a special purpose vehicle is that fund of funds by and large can be blind, and they could be special purpose vehicles. So you could have a fund that is going to invest in a variety of are going to invest in multifamily funds or mobile home park funds. And once again, it might be a situation where people trust your track record as a fund manager choosing funds. So that's what makes it a blind fund, but it's a fund of fund because it's a fund that invests in other funds. Now, I'll come back to customizable. Going to special purpose vehicles, also known as SPVs, are entities that are set up to invest in a specific investment. And this could be investing into a fund making it a fund of fund, or it could be just investing into a specific syndication. Say the deal that Jerry mentioned that is available right now. Say you want to raise some capital with some friends or people that you don't know. So you're raising money on social media or whatever of that case, you will then create a special purpose vehicle. You'll launch your PPM with your attorney and all that good stuff to then invest in his fund. Now, number 3 is customizable funds. So customizable funds are funds that allow investors to customize their experience. So what that means is you create an entity, you have a PPM, and there are 2 types by and large. So one is, if you're familiar with the Avestor platform, Avestor has a customizable, they have a platform where you can create a customizable fund on it. And that platform, I will touch on the fees in a bit, but you'll go through the process of creating your PPM. And then you don't necessarily have to create another document after that, another legal document, unless you want to create side letters for every single investment, but some people don't. But this enables investors to then invest in the fund and choose which deals they want to put money towards. They are not, when they put 100,000 or 25K in, they're not putting it across, they're not just getting diversification across all the different deals that are in the fund. They get to actually say, you know what, I want to put money in this investment, that investment, et cetera. And you can then set your minimum investment for each of the different investments. So that's the customizable fund, pathway. Then you have, before I move off of customizable funds, so that's Avestor. You can create customizable funds outside of Avestor. So you could go to your lawyer and say, hey, listen, I want to be able to create a fund that allows my investors to choose what investments they want to put their money into. And you would just tell the lawyer that, and you and him together would create the PPM. So I have a fund like that. And then what I do is I have a side letter for every single investment that I choose to offer in my fund. So as people invest, as I choose an investment and I offer it, people then invest based on the offering that they like. So if they like this one, they'll come into this particular investment, they sign the side letter for that particular investment, and they go into that deal. If they see the next deal, they don't like it, they don't have to invest. They're not diluted because they're not in that investment altogether. Each of the investments are separate in that fund. So that's a customizable fund as well. The difference between both of them is that on the Avestor platform, people are able to come into investments all year round. So 365 days of the year, your fund is open and can accept money. For me, I usually just keep a window of like 1 month where I'm accepting people into that particular deal. And then once that time is over, there's no more other people. And the reason for that is because Avestor, you're paying more to Avestor because they have a platform that is calculating the amount of time people are in deals. And that takes a lot of work and a lot of brain power. And that's why they get paid the big bucks for that kind of stuff. So that's what's going on there. And then to touch on the last bit in terms of funds here are open-end and closed-ended funds. So you have open-end funds are funds that are like open, going back to Avestor. That's an example of funds that are just open all year round. People can come in. You have closed-ended funds. These are funds, as I said, the example for me, I have a set period of time that I'm accepting investors in my fund, and then I close it down. And then I'll open it again once I have my next investment opportunity to allow people to come in. High level, those are all the different funds. So then I want to just pause here to then circle back to some of the information some of the questions that people had. So in terms of, so I have covered, if you're an operator and you're seeking to do the funds, like I said, track record is super important. I've just covered all the different types of funds at a high level that's out there. And then thirdly, if you're in investor relations and you're thinking, could this be beneficial for me? Like, would I want to set something up for this? And going back to some of the questions that were asked earlier. So the first things first is that I think that going back to the different types of funds, I think that customizable funds and special purpose vehicles can be great ways for people who are focused on the investor relations part of the business to participate in syndications and do so legally. Because if you have a deal that has like 10 different capital raisers, I think that it can be like, if the SEC decides to probe into that, they might ask questions about like, what are all the different people doing? And are all of these people actually doing stuff? Because people should be doing something, because those are the rules. Whereas when you have your own entity, you're sort of taking care of that entity. And that enables you to sort of be protected from that scenario. So you'll find that as people grow bigger, as operators get larger in size, they will start playing with just strictly fund managers, and they won't allow people to just come onto their GP willy-nilly, because now they're actually building a bigger business and they realize that they could be selected by the SEC for review. So it's just something to consider. However, if you're just starting out, fees to consider when setting up SPV vehicles, as well as some of the funds that I talked about. So if you're going to set up an SPV, a special purpose vehicle, that's pretty much, it's a one-time. So you set it up for this particular special investment, or maybe it's like 3 investments that you've identified. The idea is that once you set it up, you can't necessarily use it again. And that's the reason why some people will choose to set up a customizable fund that I mentioned earlier. So SPVs could range anywhere between 5,000 to about 20,000, depending on who you decide to go with. So like, for instance, I've heard Trasher, for instance, they will do SPV vehicles for about $5,000. You have other lawyers who will do it for about 10,000. And I know Lisa Kim Taylor, very great SEC attorney, she'll charge you about 20 grand for an SPV vehicle. So that's how much it will cost to get the PPM done. So that's the first thing. And then the second thing is blue sky filings. So blue sky filings will be our fees that you have to pay the state if you take money from an investor in that state. So for instance, if you take money, if you have investors, if you raise $500,000 or $1 million from 10 different investors or 20 different investors, if some of those investors come from states like New York and Boston, they have higher blue sky filings, like $1,000 and something. I was talking to someone today who had set up an SPV vehicle for 5,000 with Trasher. But they had blue sky filing fees in the region of almost $4,000. So you're thinking, wow, like that's crazy. And I think that this is where the fund can help you, because like, if you set up a fund, you do the blue sky filing fees one time. Once you raise the next deal in that entity, you don't have to be paying blue sky filings fees again, because you've already paid to be in that state. So you're good to go. You don't pay for each investor, you just pay to essentially take money from investors that live in that state. So the blue sky filings are variable. It'll depend on where your investors come from. But you can budget anywhere from, I would say, $1,000 to maybe $3,000 for blue sky filings. So that's on top of the PPM. And then annually, you can anticipate anywhere between like $1,000 to about $3,000 for your K1 filings. So those K1 filings are done annually by your CPA. And there are different CPAs out there that are willing to charge. I've heard some that are willing to charge $700, $800, and then others that are in the $2,000, $3,000 range. So there's that. Smaller fees are like your like Delaware or Wyoming state fees, like 160 with your registered agent kind of thing, $100 ish for the year. But beyond that, I think that covers your fees. If you decide to have a portal, obviously, the portals that are out there, you have Syndication Pro, you have Cashflow Portal, and then you also have InvestNext. Cashflow Portal is one of the most reasonable ones I have found out of the three. And however, if you get an investor from his marketplace, he actually he has some kind of arrangement regarding getting a piece of the promote and like the equity for that investor on the back end. So you just want to have a conversation with Perry to just sort of understand how that fee is broken down on the Cashflow Portal. The other two are, you can't find any investors on their portal. So it's just a straight shot there. So yeah, so to combine on fees, I would say budgeting anywhere between 12,000 to about 12,000 to about 25,000 to launch /SPV/fund vehicles is what I would put aside in terms of fund costs. And then the other thing to note is compensation. I know that's not a question that someone asked, but if you're going to talk about fees, I think it just works hand in hand to think about like, how do fund managers make money? So the way you make money is you either charge a fee at your fund or you negotiate better terms with the operators. All right, so if you charge fees at your fund, it could be a 1%, 2% fee, either one time or annually based on, it could be based on the amount of capital raised, or it could be based on just splitting the distributions that you receive. Some people just do a 90-10 split or a 2% and 98% going to investors. Whatever you choose to do, you would outline it in your PPM so that way investors know what the fees are. Keep in mind that if you do decide to take the path of charging fees at your entity, you then have to make sure that you go through the process of updating the offering memorandum documents, because the returns are going to be lower for people coming through your entity because you have an additional layer of fees. So you just want to keep that in mind. Now, how could you avoid having to do that or still charge fees but get compensated differently, like have it set up differently? So I think there's two ways that I think are better. Well, there's three ways that are out there. One is people will overraise. So like if they're going to invest in a deal, they're going to put $1 million in, they might raise $1,025,000, and that 25 then becomes their fee to compensate them. And they'll document this in the PPM so that way investors are fully aware of what's going on. The other option is having conversations, negotiating with operators. So either you negotiate beforehand or you work with an operator that already has a class of shares geared for a higher check size. And those could either be $500,000, $1 million, or even $5 million check sizes. As the check sizes get larger, they usually have better terms. And those better terms could either be a discount on share price. So instead of buying shares for $1,000, you might be buying shares for $800, but you get the same amount of shares, but they just cost less. Or it could be situations where you have a higher preferred return. And in those cases, or a better split or no split at all. So all these kinds of things can help make things more preferential for fund managers. And that's what enables them to ultimately make money. I'm going to touch on what general partner GP means. So, general partner in syndications, there's two teams. You have the general partner team and you have the limited partners team. The GP team consists of four key roles: people who are out there doing the managing all the acquisitions, they're looking for the deals. And then you have underneath them typically the underwriters who are underwriting all the deals to help them decide what deals they want to stay to acquire. You have asset management. So after the deal is acquired, these people are managing the asset to make sure everything performs as it should. And then you have investor relations. They're communicating with the investors, raising capital and making distributions. Technically, everyone is involved in raising capital, not just investor relations. So that's the synopsis of general partner team. What size does it make sense to launch a fund? Great question. If you're going to do an SPV, I think that the answer is ideally around 2 million. However, people do launch at around 500,000. If you're less than 500,000, I wouldn't advise doing so, primarily because you're unable to get that economies of scale of that larger check size, because usually at that 500,000 is when you're able to negotiate better terms with operators. So I think it's worth it to at least raise as much as you can. However, if you decide to do a customizable fund, I think that those vehicles, you could start with a lower minimum. So I know most of you probably know Hunter Thompson. He's very popular on the scene, with Raise Masters and all that stuff. And if you listen to him and his story, when he started raising capital almost 10 years ago, yes, I said that, 10 years ago. He's been in this business a really long time. He mentioned that when he started raising, he raised on a mobile home park deal, and the room that he was in had enough money to fully fund the deal. Like whatever he was trying to raise, they could definitely give him that money. They were all accredited investors, and he raised no money, zero. And he talks about how he had a relationship with that sponsor, and through that relationship, he was able to get to his raise goal, which I think was 500,000, and he was able to raise up to like 700 or 800. But it took him almost a year to do that, almost a year. So I think that many times the capital raising scene, like people lose sight of a couple things. One, it takes time to raise capital, because raising comes from building relationships and track record and planting the seeds and consistently being out there, and you delivering on your investments, or working with good operators who deliver, all of that stuff. It takes time. And sometimes people think that, oh, there's some kind of pill that I can take that can just make this be faster. And the truth is, there is no pill. Like, you have to get started and keep going out there and do your homework and get smarter as a fund manager, as an investor, to pick really good deals and know which ones to walk away from, because bad deals will hurt you. They will, like they can, because people will be like, oh, like I didn't understand, like, whatever reason it might be the case. So that's what I would say. So going back to the customizable fund, that's where the customizable fund can help people who are getting started, is because by having those kinds of fund vehicles, it enables you to raise capital on your terms. And you're not like, okay, like if you didn't get 500,000 or 1 million, it doesn't mean that you don't launch. And for me, it took me a while to get to that place of saying, you know what, like I came from the fund space, but I didn't naturally go to it. And I saw a deal, it was in 2020 in the fall. And of course, 2020 in the fall, pandemic, people are like not trying to invest. And it was an operator that I had extensive experience with. This was like her like second or third deal together, and couldn't raise anything. But ultimately, I think I got up to like 100 or 200, but I didn't get to 500,000. So I couldn't launch the SPV. And I asked around with other people, and no one else was really interested in raising. They were just like, I don't like this time in the market. And looking back, like she's now sold the deal and it's done extremely well. I think it was like over 40% IRR and all this good stuff. And I look back and I'm like, wow, like I really wish I had I had a fund then to like, create the entity and be able to launch it and invest and build from there. But everything happens all in its good time. So I just think that if you're out there and you are raising capital and it's not been coming like super easy for you, I think that's where things like, continuing to take a step back and sort of say, hey, what are some of the other options that are available? I could set up a customizable fund, continue to raise capital from investors, provide returns, and over time be able to be in a position where you're able to raise significant amounts of money, but you also have really good systems and relationships in place. So that's what I would say for that. Uh, I guess any questions at this point? I think I'll pause where I'm at right now and see if there's questions or like comments or anything.
I'll jump out there because we had a great discussion about fund of funds and how they're structured, how they're put together.
Mhm.
But also, can you talk a little bit about, because ultimately you're going to be dealing with and investing with other sponsors. So talk about how you vet other operators and sponsors that you are willing to work with.
Oh, yeah. Ah, it's a journey. All right. So I how I've approached this, I had to take a step back and say, okay, what do I need to see to get comfortable like raising on a deal? And what I began to do for myself, I came from what I am stronger in, which is analysis and that kind of stuff, because I am an accountant by trade. So what I started to do is I I've been around the space for a while now. So from a personality perspective, like I respect a lot of the players and operators, and I think they're great, great ladies and gentlemen. But so from a like whether I believe that they can do the deal, yes. Like I think, okay, yeah, I know you can execute and all that good stuff. So then the next bit is like, do I like this deal? Like, how do I assess, like, how do I get comfortable over the different numbers that are being shown? And like the debt and all that good stuff. So what I ended up doing was creating, and I'm still in the process of creating it now to this day, is like creating a database of investments. And does it take time? Yes, it does. But if you are not actively operating and buying deals to yourself, how do you get comfortable that expenses, expense growth, expense ratios, um, interest rates, uh, caps, loans, um, rent growth in the area? How do you get comfortable that all that stuff is reasonable? The only way you can do that, in my opinion, is by seeing deals like seeing multiple different deals from independent sponsors in that particular market. And then over time, you start to be able to see, okay, yeah, I'm expecting this kind of expense ratio. I'm expecting this types of rent. Um, and it also helps you to sort of see deals that stand out from the pack. So, like for instance, the first deal that I offered in my fund earlier this year, this was around like March, April-ish, May. I was looking at a variety of different deals and I put them all in the sheet and I was just looking at all of them and everything. And then I began to see, oh, like time and time again, bridge. Every deal that came was a bridge debt. And then I got a deal that was a permanent. And then when I looked at the returns, I saw that the returns were very similar to some of these deals that were using bridge. And I was like, huh, why would I take the risk of taking a bridge when I could be in a deal that has permanent debt here, given the current market situation? And I could see that because I was looking at a variety of different deals, and I could see that very little people, small amount of people were coming with permanent loans. And same thing with cap. Like there was someone who came, like I liked the group, like they're good friends of mine, and I trust them. I believe that they can operate, but like they came with a deal that had no cap and it was a bridge debt. And this was like the same time period, March. And from March until now, the Fed has increased interest rates twice. So, and I remember saying to them, I was like, are you going to buy a cap? And they were like, no, we're not going to buy it. I was like, okay, all right, I'll pass. So it's like things like that. Like you wouldn't, and then, I'll talk to investors who are strictly LP, and you'll say cap, like buying a cap, and they're just like, it's like they have no clue, no clue, so like they would easily probably have invested in that deal, right? Because they don't realize that maybe the operator should put a cap on this interest rate because the interest rates are going up. So that's what I do. Due diligence is an ongoing art. Um, for me, creating my database, continuing to build relationships with more and more operators, getting to know people, asking around, being on forums, being in different groups, asking people, hey, have you worked with this operator before? What has been your experience? Um, Getting on calls with operators, getting to know them, their business plan, how their business are structured. I think, that's the value add I bring to investors who aren't my investors who aren't doing that. Let's just be honest, like they just don't have time, and it's a lot. It's a lot to do. So yeah, that's the value add I think of fund managers, is that we're out here, we're very much in the thick of things, and we're like super LPs because like I invest my own money into deals too, and so I also want to protect my capital that I am deploying alongside my investors. So that's what I would say. So long answer for due diligence.
Thank you. Thank
Yeah.
you. So there's got to be some more questions, so I'll leave the floor open. No one else? There's got to be someone. Come on. If not, I got lots of questions. You know,
Hey, if I could jump in real quick, sorry, Jerry.
Yeah, go ahead.
Lisa, I'm just curious how you structured your first fund as far as with your fee structure and whatnot.
Yeah.
Which way did you end up going?
Yeah, great question. So I decided I decided that I wanted to create a track record fund for myself. So what that meant was I have done a customizable fund that I have chosen to bear the cost of the expense to set up my fund. Because I want to use this fund for the next 2 to 3 years to raise capital with good operators, and to demonstrate that I have the ability to choose and partner with really good people who actually give people back their money and returns. So yeah, so that's how I decided to structure it. And if from my perspective, by doing this, like my hope is that I will eventually grow to the place where I am able to raise $1 million and more. And when that kind of situation happens, you can work with, there are sponsors out there where if you bring like $1 million, like by time the terms are all worked out, you're able to like compensate yourself for the fees of setting up your entity and all that good stuff. So yeah.
And I think that's great. I mean, it shows you're in it for the long haul. You know, you're
Yeah,
thinking.
this is not a short-term thinking thing.
Right.
That's the other thing, actually. Thank you for bringing that up. I think that funds are a long-term play. And I hope that people who decide to pursue that path understand that, because it's not something that's going to pay you tomorrow, unfortunately.
Thanks.
Yeah, no problem.
Lisa, thank you
Hey.
for all the information.
Sure.
Another question that's kind of on the side of the setup fees that you were speaking about earlier.
Mhm.
You mentioned that all of the different types of funds, obviously have different costs. And you said that different lawyers charge different amounts, but does the amount have to do with how much you're going to raise? Like, let's say
Mm.
your fund is $1 million to 5 million or 5 million above, or unit size or anything like that?
Nope.
No.
Yeah.
Okay.
So it's based on the type of fund that you're launching. So
Mhm.
if you're doing an SPV, the SPVs are usually cheaper, anywhere between 5 to about 8,000. The trasher people, I think they're the ones who have heard will charge 5,000. Nick McGrew, I think he's about 8.
Okay.
And then Lisa is one of the most expensive, along with Mauricio Rawl, who's always on Facebook doing lives. He's also very expensive. So he's in the 20K range as well. Yeah. Then if you
The two
decide
you
to,
mentioned last are the ones I know the best, of course.
yes, they are the most popular. They're out there, but they also cost more
Sure.
as
Okay.
well.
Okay. Thank you.
Yeah. But Nick is
Lisa-
pretty good. He works a lot with Blue Lake Capital and Vina Jetty, and they're really good sponsors. Those two ladies have a fund called Rev Fund,
Mhm.
which is an evergreen fund that invests in multifamily. They're an example of the structure that I mentioned earlier. They're operators. They did a lot of singles. So they did a couple, couple singles, went full cycle, and then
Okay.
decided to launch their own fund.
Awesome.
And the way they do theirs is that the fund is closed when they don't have any investments. And when they have a new investment offering, they open the fund, you invest, and you then invest at a higher share price. So every time they reopen, the share price to invest in the fund increases. So that's how they're able to rebalance the fund to make everything equal across the different investors, because people who've been in it from the very beginning came in, they should get more of the income allocated to them because they've been in the fund longer.
That's interesting. Okay.
Yeah.
One other question, but it's a little unrelated.
Sure.
So you mentioned that, obviously as a fund manager, you are the one that's essentially interfacing between the sponsor group or GPs and your LPs.
Mhm.
How have you found communicating with your LPs after they actually invested in the fund?
Mhm.
Like, do you like to communicate with them, via emails or through your Invest Next portal? And then how often? And are there certain things that you find that investors really want to know about, and certain things that, could go along just aren't that interesting to most investors?
Yeah, great question. So for me, I do monthly emails. So they, go through active campaign actually out to my investor base that are in my fund. Um, I usually don't have any questions from investors, to be honest with you, as long as things are moving along well. And so far, the deals that I've been in, fingers crossed, have all been humming along quite nicely, providing, the returns as promised and on schedule. So that makes it very easy. So yeah, that's what I would say.
Okay. Thank you very much.
Yeah, I think that people typically will have questions when things aren't going well.
Mhm.
So like the deal is underperforming, you'll get questions from investors, or they're late on distributions or late on K1s. People want to know like what's going on there.
Okay.
Luckily, I've not raised on any deals where that's been the case, but I have been an LP on deals where K1s are late.
Mhm.
Money is late in distributions. Yeah, it's
Do you
fun
dive
stuff.
into things like, they've turned 10 units this quarter, and to like they're doing this and that to each unit,
Yeah.
and they're landscaping the exterior, or do you keep it strictly the numbers, the money?
Great question. So I did my first SPV in 2019, in the fall of 2019. It was myself and a few other ladies. That deal has now closed and sold. Investors got back their money and moved on. And that deal, when we did get correspondence from the operator, we read it. And like if things don't jive from month to month, we would send them a note and just be like, hey, like this doesn't make sense. Like, are you sure this is right? And whatever. And then they'll just come back and they're like, oh yeah, we made a mistake there, whatever. But yeah, as a fund manager, I think you're probably doing a lot more reading and reviewing than investors, I think, because sometimes investors, I have friends who they are LPs and they don't even check to see if the money has hit their account. Or they just have so
Okay.
much money hitting their account that they just lose track. So yeah.
Okay. Yeah, that's a
Yeah, yeah.
problem I would like to be in. I appreciate that. Thank you.
Actually, as I say that, if you're familiar with Left Field Investors, they have a podcast. And someone recently, one of their latest podcast episodes, I think this week or last week, there's a group that is a startup that has created a software for exactly that, for those super LPs that are in a variety of different deals and they have so much money hitting their bank account, where the startup is sort of keeping track of all the different distributions and all that stuff.
Yeah,
Oh,
it's called Visor. It's called
yeah.
Visor.
Yeah,
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 I'm
yeah,
part of that
yeah.
group as well. Yeah.
Are you? Okay,
Yeah.
great. Awesome. Yeah, I like Left Field Investors. They're awesome.
Right.
As I think about Left Field Investors, and you're in that Left Field Investors group, it would behoove me to not talk about TribeVest. So for anyone who's here and who's thinking, you know what, I don't know if I want to raise capital. I don't know. I really don't know. Then I think TribeVest is a good platform to test out your capital raising. First of all, I would only do it with people that you know. I wouldn't do it with people you don't know. You can do it for 506B or C deals. Obviously, if it's C, everyone in the tribe will need to be accredited. Period, full stop. No ifs, ands, and buts, right? If it's B, then you have sophisticated investors, you know the drill. I think that it's a good way to sort of have an email list of people that you know. Say you see a deal out there you like, reach out to people that you know and say, hey, listen, I've looked at this deal. It looks really good to me. I think I want to invest in it. See if other people want to invest alongside with you. You guys create a tribe together and you invest in the deal together. And, you do a couple of those and you start people in the group might start realizing, oh, maybe they like to raise capital and they'll go off and do that if that's their fancy. But I think more than likely you'll have people who are just like, you know what, I like being passive. And then next thing you know, now you can create a fund. Maybe you create the SPV, as I said, or maybe you do the fund customizable or a vestor. But that's you building your track record, and it's a less of a hurdle. Like I think it was someone else had asked about, I think Gonzalo had asked about fees. Like the fees for TribeVest are not as crazy as they are to launch an SPV vehicle. And I might just defer to Greg here. He might have done a tribe for all I know.
Yeah, I mean, essentially, that's what I've done. I mean, I did tribes before they had TribeVest. So yeah, it was my brother, a couple of friends. We put a few people together, and so it's basically the same idea. And
Yeah.
Yeah, I talked to Jim Pfeiffer about that, actually.
Yeah. So how did the fees work for you, Greg? Because I think people would love to know how that works on the Tribe Vest.
Well, I mean, I haven't actually done the TribeVest, but with my own group, we've just,
Yeah.
we've raised, hey, 5,000-10,000 per person, whatever it is, and then we add a little more on to cover fees for setting up the company for the LLC, paying for taxes as we would go along, and paying for annual registration fees. So it's just kind of, and then once you get the distributions, you can use some of that to kind of pay those fees going forward. But
Right.
but I think that's essentially what TribeVest is you're kind of doing.
Got it. Wow. So you actually create your own LLC. Is it like PPM or not really?
Yeah, not really, I guess. So
Because it's all people that know each other.
yes.
Mm,
So
got
Yeah,
it.
you have to really know each other.
we do really know each other. Yes.
Greg, I was gonna say, I'm sure you guys have an operating agreement though that
Yeah, oh, yeah.
stipulates everything.
Right. We've created an operating agreement, and right. So that's part of it.
It's kind of like a JV, right? Everybody's sort of active.
Yeah, essentially.
Active.
Got it.
Hey, Lisa, I had a question for you.
Yes.
I don't know if you've heard of this fraud case that's come up in New Jersey for the NRIA people, the National Realty Investor Advisors. It's like a huge 600 million Ponzi scheme. Basically, it's a fund that they started, and people from the Northeast would probably definitely remember the ads that they've heavily marketed over there. Anyways, yeah, so it's being investigated now. I'm kind of a nerd like that, so I kind of read through the cease and desist order that was issued back in June of this year by the Attorney General, and it's got some really juicy stuff in there. I don't doubt that they'll make a movie out of this in a couple of years. Like, that's how crazy some of the stories are in there. But I did want to ask you, like, have you, can you share maybe some things that could get people potentially into trouble, or things, more on that side of like just making sure that you have everything on the up and up, because this stuff can be pretty serious, if you start getting into a little bit of hot water like those guys did.
100%. Really good question. Oh my goodness. I think the first thing is, I think that you want to document what your plan is, like in terms of like how you're planning on splitting the returns. If you're going to take any fees, what that fees are going to look like, what expenses the fund is going to cover. It's super, like, all that stuff should be clearly outlined in the PPM. If you have the fund paying rent, like covering rent for places and like all that kind of stuff, like that can definitely get you in trouble. So you definitely want to get super clear on the way the fund is compensating people, you yourself, the fund manager, what expenses the fund is going to cover and not cover. And then as you think about like some of these customizable fund vehicles, like for me, I've taken a very conservative approach of sort of saying, okay, listen, I'm giving myself a window of 1 month to raise for this deal, close down, finished, right? I think that when you have this ongoing window, that's where like, probably going to someplace like Avestor would be beneficial, because, you don't want to get in trouble with like not allocating the right amount to the right people, and like the amount of time an investor has been in the fund and all that good stuff. Like that can just get really muddled up really quickly. And I think that it's just very burdensome, and I would not advise doing that. I think the other thing too is just, I would say, definitely keep track of the money that comes into your entity for different investments. Like, for instance, if like, I haven't done this personally, but like, say you decide, some people might be like really zealous and like want to like raise for multiple deals at one time, and then you have cash coming in, like sort of making sure that you understand, like keep track of what cash is going to what investment, and not like commingling that stuff. I think it's like very important as well. Yeah, definitely not using the fund's money for any personal use. I think is big no-nos all the way through, like huge no-no. The other thing, which was a question that Gregory asked about how I am managing the expenses for my fund. And I said that I decided that this is going to be a track record fund. I'm actually bearing the cost of the expense of the fund myself. So one of the reasons for that is because, like, I think that if you're going to launch one of these types of customizable vehicles that are not going to be on Avestor, I think that the right way to do this is to set a specific time for your investment period. So maybe your investment period is a year or 2 years, where you're going to focus on on finding deals to put into your entity, and then you close the entity down for investments. And then you would take the expenses and allocate them across your entire investor, across all the different investors that are in your fund based on the amount of money they have invested in the deal. So based on the amount of money they've invested in the fund. Because I say that because, like, for instance, if you have an evergreen fund, which is a fund that doesn't end, and you have, like, I don't know, $50,000 in expenses, legal expenses, and whatever startup costs in the first year, then all the people who were in the first year who invested, they would be bearing all that costs. Second year, third year, the fund is still going. You're buying more assets. Year 4, year 5, year 10, you're still bringing in more assets in the fund. And maybe those are now new investors. They don't get allocated any of the expense from the beginning. Like, it's not right. Like, that kind of stuff can get you in trouble. So that's where, like, playing with Avestor, who is allocating, they're seeking to, like, they're saying, I don't know, like, I'm not doing the accounting for their system, but bases across the different investors. And I think that that's those are the key things. Like, it's the allocation of income correctly, the allocation of expenses correctly, using the money that the fund receives from investors correctly. So using it for approved either investments or expenses, and not using it towards personal stuff, and as well as expenses that it doesn't belong to. So yeah.